All right, let's dive into something that's honestly a really cool part of the investing world: dividends. We're going to break down how a stock, a piece of a company you own, can actually pay you a steady income without you ever having to sell it.
It's a fantastic question, isn't it? I mean, most people think the only way to make money with stocks is the classic buy low, sell high. But what if the company you invested in could just send you a check? A direct deposit? Well, that's exactly what we're going to explore.
So, the answer to that big question is one word: a dividend. And here's the best way to think about it. Imagine a successful company is like a big, healthy fruit tree. The money it makes, its profits, are the fruit growing on its branches. A dividend is just the company deciding to pick some of that fruit and share it with the people who own the tree. That's you, the shareholder. You get a piece of the harvest without ever having to touch the tree itself.
So, where does this fruit, this dividend money, actually come from? To understand that, we need to get inside the company's head a little and look at the big choice they have to make. And here's the key thing you got to remember: a dividend is paid out of a company's profits. After they've paid all their bills, paid their employees, covered all their costs, whatever's left is profit. And with that profit, the company's leaders face a choice. Paying a dividend is an option, but it is absolutely not something they're required to do.
And that choice really splits companies into two main camps. On one side, you've got what we call a growth company. Think of it like a young sapling. It uses all of its fruit, all of its profit as energy to grow bigger and stronger. It plows everything back into the business. But then you have the dividend company. This is usually a more mature, established tree. It's got a reliable harvest, and it decides, hey, we've got more than enough fruit here. Let's share some with our owner. Okay, so we get the idea. But how does this work in the real world? How do we measure it? How do you actually get the money? Let's get into the key numbers you need to know. We're going to use a super simple example to make this all click. Let's just pretend you buy one single share of Fruit Tree Incorporated for exactly $100. Okay, that's your investment. Now let's say Fruit Tree Inc. decides to pay you a dividend. Over the course of a whole year, they send you a grand total of $4 in cash for that one share you own. This isn't some number on a screen. This is your actual dividend income. It's the fruit, the cash, that lands in your account.
So what does that $4 really mean? Well, that's where you'll hear people talk about the dividend yield. It's just a simple percentage that makes it easy to compare different stocks. You just take the annual dividend, our $4, and you divide it by the stock's price, our $100. Boom! That gives you a 4% dividend yield. It's a really handy metric that tells you the return you're getting just from dividends relative to what you paid. And you probably won't be waiting a whole year for that money. As you can see, the vast majority of companies that pay dividends do it quarterly, so you get a little bit of cash every 3 months. Some pay once a year, and a few even pay out monthly, which can feel like a really regular little paycheck.
Okay, now we get to what is honestly one of the most powerful concepts in all of investing. What do you do with that dividend cash once it hits your account? Let's talk about the engine of growth. See, you've got a choice. You can take that $4 and go buy a cup of coffee, or you can reinvest it. This means you tell your brokerage to use that dividend payment to automatically buy more shares or even fractions of a share of the same company. In our analogy, it's literally like taking the seeds from the fruit you just received and planting more little fruit trees right next to the big one. And this is where the magic happens. Look at how this builds over time. Say you start with 100 shares. That 4% dividend gets reinvested, and after 1 year, you've got 104 shares. Now here's the thing. All 104 of those shares are now earning you dividends. You fast forward 5 years, you're at 122 shares. After 10 years, you're sitting on 148 shares. It's a snowball rolling downhill, picking up more snow, getting bigger and faster. That is the incredible power of compounding.
All right, it's really easy to get excited about that snowball, right? But we have to pump the brakes for a second and take a calm, clear-eyed look at the other side. Because, like any investment strategy, this is not a guaranteed path to riches. Let's do a quick reality check.
These are so important to understand. First and foremost, dividends are not guaranteed. They are a choice, and a company can choose to reduce them or stop paying them completely, especially if times get tough. Second, just because a stock pays a dividend doesn't mean its price can't go down. You can still lose money on your initial investment. And finally, you have to be careful of super high yields. Sometimes, if a yield looks too good to be true, it might be a warning sign that investors think the company's in trouble and that dividend might get cut. This quote just sums it all up perfectly. At the end of the day, dividend investing is a strategy. It's an approach that focuses on the potential for income and growth over the long haul. but it is not and never will be a promise. So, after all that, what's the one big idea to walk away with? I think it's this. The core idea of owning a dividend stock is that you're not just hoping the stock price goes up. You are becoming a part owner in a business that is profitable enough and stable enough to share its success directly with you, in cash. And that's a pretty powerful idea.